Hello friends, let us continue with the topic Introduction to Partnership and Partnership Final Accounts. In my previous lectures, I explained the theory of partnership and I also explained the methods of capital accounts. In this lecture, I am going to explain preparation of partnership final accounts. This topic is divided into two parts: why final accounts are prepared and how final accounts are prepared. So let us see first why final accounts are prepared. Now you know the aim of any business is to earn profit. Now how can we know that whether we are earning profit or we are suffering loss? For that we are supposed to write the books of account. And business being a continuous process, we cannot continue till the end of the life. So we have to close the books at certain intervals. That is, normally at the end of the year, we are closing the books of account and we are preparing final accounts. So what is the object of preparing final account? The object of preparing final account is to know whether we are earning profit or we are suffering loss. We want to know what are our assets and what are our liabilities. In addition to this, we want to know the debtors of business, the creditors of business, the capital invested in business, the loans taken by business, the expenses of business, the incomes of business. All these are known only when we are closing the books at the end of the year. It means the object of preparing final account is to know the results of business. Now, whenever we are preparing the final account, we have to also complete the legal requirements. What are the legal requirements? The income tax that we are paying to the government is always based on the profit and loss prepared by the firm. So there is a necessity to prepare the final account because we want to pay tax to the government, and at the same time government has also fixed financial year. In India, the financial year is starting from 1st April and ending on 31st March. So naturally we are also closing our books of account on 31st March every year. So now it is clear that we need to prepare the final account to know the results of business, and after knowing the results, it is easy for us to take managerial decisions. Now we will see how the final accounts are prepared. Here I am talking about the procedure under which we are preparing the final account, or what procedure is followed to prepare the final account. Now you know that in our second topic in FYSC, Principles of Double Entry System, we have discussed about the working of double entry system. How the double entry system is working? First, the business transactions are taking place. These transactions are recorded in the primary books. Which are the primary book? Journal, subsidiary book, cash book, etc. are the primary books. So the transactions are recorded in this book. Then these transactions are posted, that is transferred to a secondary book which is known as ledger book. And ledger book, as we have decided to close the books at the end of 1 year, periodical requirement. So at the end of 1 year, we are closing the books of account, means we are closing all the ledger accounts, and the balances of ledger accounts are recorded in a trial balance. So now what is trial balance? Trial balance is a summary of the balances of ledger account. In other language, we can say that the total summary of the transaction is given in the trial balance, and at the same time Now the trial balance is acting as an agent between the books of account and preparation of final account. At the same time, trial balance is also helping us to know the errors, if any, in the books of account. So we are preparing trial balance, and with the help of adjustments, trial balance and adjustments. Now what are adjustments? Adjustments are the additional information given below the trial balance. If we are not incorporating the adjustments in the final account, then our final account may not give true profit or loss. At the same time, our final account may not give the true financial position of business. That is why it is necessary that we should have given trial balance and adjustments. So from the given trial balance and adjustments, we are preparing the final accounts. And what is there in the final account? We are preparing the trading account, we are preparing the profit and loss account, we are preparing partners capital account or current account, and we are preparing balance sheet. So this is the procedure how we are going to prepare the final accounts. Okay. Now our next heading is content of partnership final account. Now which are the contents of partnership final accounts? We are preparing three accounts. One is a trading account, another is profit and loss account, and third is partners capital or current accounts. So these are the three accounts, and one more, we are preparing a statement which is known as balance sheet. So now the final accounts are the combination of three accounts and one statement. Which are these accounts? Trading account, profit and loss account, partners capital account or current account, and balance sheet. Now I will give you the basic idea of all these accounts. I am not explaining the format. Format I am going to take separately in next lecture. I am going to teach you separate format for trading account, separate format for profit and loss account, separate format for capital and balance sheet. Now I will give you the basic idea of trading account. Now what is trading account? Trading account is a nominal account. In this account, we are comparing direct expenses with direct incomes. If the direct incomes are more than the direct expenses, the difference will appear on the debit side, which is known as gross profit. If the direct expenses are more than direct incomes, then the difference appears on the credit side, which is known as gross loss. And whatever is a gross profit or gross loss, that is transferred to another account, that is the next account, profit and loss account. Now, let us understand the equation form of the trading account. Now, the equation form of trading account is like this. Let us say the formula. The formula is gross profit is equal to sales minus cost of goods sold. So this particular formula is incorporated in this trading account. What is the gross profit? Gross profit is sales. Sales here means we are assuming sales minus sales done, so that is the net sales. So sales minus cost of goods sold. Now what do you mean by cost of goods sold? Cost of goods sold means opening stock of goods plus purchase of goods minus closing stock of goods. So I will give you an example that suppose the sales is 10,000 and the opening stock is 2,000, purchase is 7,000, closing stock is 1,000. So sales is 10,000 and cost of goods sold is 8,000. 7,000 plus 2,000, 9,000 minus 1,000 is 8,000. And now 10,000 minus 8,000 is 2,000. So the gross profit is 2,000. This formula is incorporated in the trading account. Okay. Let us see how that formula is incorporated here in the trading account. First, the sales is 10,000. So on the credit side, we are recording 10,000 as sales. Then opening stock is 2,000. So I am recording opening stock 2000 on the debit side, purchases 7000 I am recording on the debit side, and closing stock 1000 I am recording on the credit side. Now sales minus cost of goods sold. So what is cost of goods sold? Opening stock plus purchases minus closing stock. So this becomes the cost of goods sold. So now this is the cost of goods sold. What is cost of goods sold? 2000 plus 7000 is 9000 minus 1000 is 8000. So cost of goods sold is 8000. So 10,000 minus 8,000. So the difference is 2,000. That is the gross profit. So what is gross profit? Sales minus cost of goods sold is gross profit. So we can understand the trading account with the help of equation also. Now we will see the format of profit and loss account. In profit and loss account, on debit side, if any gross loss is there in the trading account, then that gross loss is transferred on the debit side. If gross profit is earned by business, then that gross profit is transferred on the credit side. On the debit side, we are recording indirect expenses, and on the credit side, we are recording indirect incomes. Now, if the indirect incomes are more than indirect expenses, then the difference appears on the debit side, which is known as net profit. And if the indirect expenses are more than indirect incomes, then the difference appears on the credit side, and that difference is known as a net loss. Now, whatever is the net profit or net loss, that is distributed between the partners in the profit sharing ratio, and it is transferred to partners' capital or current account, whatever may be the case. Now, our next format is capital account or current account. See, in the previous lecture, in the methods of partners' capital account, I have already explained in detail the format of the partners' capital account and the format of the partners' current account. These accounts are meant for recording transactions related to partner. So whenever we are passing entry on the credit side of partners' capital account or current account, the balance of the partner increases. And whenever we are passing entry on the debit side of partner's capital or current account, the balance of the partner decreases. And whatever balance is arrived, that balances are transferred to the balance sheet either on the liability side or on the asset side, as the case may be. Now, our next format is balance sheet. Balance sheet is a statement, it is not an account. And that is why we are not writing to and by. Again, on the left hand side, all the balances which are appearing, they are credit balances, they are the liabilities of the business, and on the right hand side, whatever balances are appearing, they are the debit balances and they are the assets of the business. So there is a custom to show the liabilities first and to show the assets on the other side. So balance sheet is showing the financial position of the business, that is, what are the assets of the business and what are the liabilities of business. And at the end, the balance sheet is going to tally. That is, both the sides of balance sheet should be equal. Okay. Now we will see the content of the problem. What is given to us in the problem? We are given trial balance and adjustments in the problem. So let us see that the trial balance is given to us. In trial balance there is a debit side. In trial balance there is a credit side. On debit side, whatever items are given, we are classifying in three parts. One, whatever expenses are there, they are of two types: direct expense, indirect expense, and other items are assets. On the credit side, we will classify the items: direct incomes, indirect incomes, and liabilities. So these are the 6 types of classification that we are doing in the trial balance. And then we are having these accounts: trading account, profit and loss account, and balance sheet. So we have to do the posting of each and every item of trial balance in the final account. So how we are doing? Let us see the debit side, debit items. So debit items will find their place on the debit side, either in the trading account debit, profit and loss account debit, or on the asset side. And the credit items, they are finding their place on the credit side of trading account, or on the credit side of profit and loss account, or on the liability side. So let us see one by one. Direct expenses are appearing on the debit side of trading account. So debit on the debit side. Indirect expenses are appearing on the debit side of profit and loss account. So again, debit items on the debit side, and assets are appearing on the asset side of the balance sheet. So the debit side is over. Now on the credit side, direct incomes are recorded on the credit side of trading account. Indirect incomes are recorded on the credit side of profit and loss account. So credit on the credit side. And all the liabilities are recorded on the liability side of the balance sheet. So each and every item of trial balance is transferred once, either in the trading or in the profit and loss or in the balance sheet. Now we'll see the adjustments. What are the adjustments? As I told you earlier, that adjustments are the additional information given below the trial balance. Without adjustments, we cannot prepare the final accounts. If you are preparing the final account, it may not give us the true results, and the balance sheet also will not give us the true financial position. I will give you an example of adjustment. Say for example, depreciation. Now depreciation is a non-cash expense, so we have not provided during the year. So at the end of the year, we have to chart the depreciation, and it should be given by way of adjustments, so that we can reduce the value of the asset from the balance sheet, and whatever loss, whatever wear and tear takes place to the asset, that is recorded on the debit side of profit and loss account. So we are doing two effects for each and every adjustment. One is a debit effect and one is a credit effect. Either we are adding or subtracting, that is something different, but the effects are one debit and one credit. Okay. Now we will see another type of classification which is also useful to us for transfer of items from trial balance to trading account, profit and loss account, and balance sheet. Now let us classify the debit side. On debit side, we are having three types of account: personal account, debit balance; real account, debit balance; and nominal account, debit balance. So whenever we are having nominal account, debit balance, we have expenses. So that expenses may be direct expense or indirect expense. On the credit side, we have a credit balances. So personal account credit balance. The real account is not having any credit balance, so it is never appearing on the credit side of trial balance. And nominal account credit balance, again we have two classification: direct income and indirect income. Now, how we are going to transfer? Let us see the debit side. Personal account debit means, personal account debit balance means they are the assets. For example, debtors, amount is receivable from the debtor. Bank, amount is receivable from bank. So these are the accounts which are personal account, and they are having debit balance. So all personal account having debit balances are appearing on the asset side of the balance sheet. Next, real account debit balance. Real account debit balance are the all assets. So all the assets are appearing on the asset side of the balance sheet. So all the real account debit balances are appearing on the asset side. And nominal account means these are the expenses. So these expenses are of two categories. Direct expense will appear in the trading account, and indirect expense will appear in the profit and loss account. So all the balances of debit side are transferred to the trading account debit side, profit and loss debit side and balance sheet asset side. Same way, profit and loss account credit balance means liability, so it is transferred on the liability side. And nominal account credit balance means income, so we are having two incomes, direct income which appears in the trading account on credit side and indirect income which appears on the credit side of profit and loss account. Now from this classification, we can make out that all the nominal accounts, whether they are on the debit side or they are on the credit side, they are finding their place only in the trading account and profit and loss account. So the nominal accounts are transferred in the trading account or in the profit and loss account, but they are not having their place in the balance sheet. And at the same time, we are also coming to the conclusion that all the personal account and real account are only appearing in the balance sheet and they are not having their place either in the trading account or in the profit and loss account. So this type of classification is also useful to the students. Whenever any new item is appearing in the trial balance, you can make out whether it is a personal account, a real account or nominal account, and accordingly you can take the decision. Okay.